scenes to guarantee completion of virtually all equity trades. We do not trade or take positions or bet on the direction of the market. We do not give investment advice. We do not know who the customers are behind the trades or their reasons for trading. We simply process and risk manage trades. DTCC protects against default risk by collecting margin, which is money that clearing members post as collateral. If a clearing member defaults between trade date and settlement, DTCC uses that collateral to complete the defaulting member's trades, no matter how much prices may have changed. Margin requirements are calculated using statistical models and model-based calculations that are set forth in our rules, which must be approved by the SEC. Margin requirements increase as the risk in the member's portfolio increases. In other words, the greater the potential loss a default could produce, the greater the need for collateral. Volatility has a very large impact on margin requirements. We saw this play out during the week of January. Both volumes and volatility that week were extraordinary. On January 27th, NSCC processed about 474 million transaction size, exceeding the pandemic-related record volume from March 2020 by more than 100 million trades. The concentration of trading in a small number of meme stocks that week was also extraordinary. Applying those statistical models and formulas, margin requirements increased substantially. I appreciate that the committee is exploring ways to continue to improve our markets. I'd like to describe one effort that DTCC has undertaken to date, shortening the settlement cycle for equities from 2 days to 1 day. That may sound like a small thing, it's just 1 day, but cutting the settlement period in half can make a difference. We believe that shortening the settlement cycle to T+1 would enhance market resilience, reduce margin requirements, and lower costs for investors. Following a multi-year industry-wide effort, the settlement was shortened in 2017 from T3 to T2, achieving margin savings estimated at 25%. DTCC estimates that the volatility reduced by 40% would have moved to T1. This could save our clearing members upwards of $6 billion per day during periods of extreme volatility. While DTCC's technology can support T+1 today, changing the industry convention is a major undertaking that will require coordinated efforts across the whole industry. Over the past year, DTCC has engaged with a cross-section of the industry to assess readiness to further shorten the settlement cycle. In February, DTCC published a white paper outlining the benefits associated with multiple changes to the settlement cycle, including a move to T1. We are working with SIFMA and ICI to accelerate this effort. Thank you again for the opportunity to testify today. I look forward.
Thank you very much, Mr. Cook. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters. Thank you, Ranking Member McHenry and members of the committee for this opportunity to testify today, together with Chair Gensler and Mr. Bodson, regarding the January market events related to trading in GameStop and certain other stocks. We commend the committee's review of these events and related investor protection concerns. FINRA's mission is to protect investors and promote market integrity. We are a not-for-profit SRO, and we support the SEC in overseeing one critical part of the securities industry, certain broker-dealers. To that end, we administer comprehensive regulatory programs, including surveillance, risk monitoring, examination, and enforcement. And we, in turn, are subject to comprehensive examination and oversight by the SEC. This committee has heard already about the events of January, including the significant price swings and trading volume in GameStop and a limited number of other stocks. In this context, some broker-dealers restricted trading in these securities on a short-term basis. This led to confusion and frustration among some investors and concerns about the fairness of the markets. The events also focused attention on the growth of popular new retail trading platforms and services, changes in investor behavior, and the influence of social media on the markets. Our markets are dynamic and continually evolving. Market participants constantly innovate new technologies, methods of communication, and investment products and services. These innovations often benefit investors, such as by providing easier access to the markets, lower costs, and a wider range of investment products and services to choose from. But they can also present new and sometimes unanticipated risks. So regulators must constantly review whether the rules governing the road need to be updated in light of new developments to better protect investors while still facilitating vibrant and innovative markets, and the opportunities these create. At FINRA, we are committed to doing just that. One important resource we rely on in this process is the research of the FINRA Investor Education Foundation, including recent research on new, inexperienced investors and how they approach investing. Since the events of January, FINRA has established an internal working group that's devoting significant resources to investigating whether its broker-dealer members complied with SEC and FINRA rules. We have also issued regulatory notices reminding firms of relevant duties and responsibilities in this area. Although I cannot comment on specific firms or ongoing investigations or enforcement matters, generally speaking, we are reviewing order routing practices, the circumstances under which trading restrictions were imposed, any potential manipulative conduct, and compliance with short sale requirements, among other matters. I can assure the committee that we will take all appropriate disciplinary or other remedial action as warranted if the facts indicate a violation of SEC or FINRA rules. The upcoming SEC report on these market events will be critical in analyzing whether existing rules and standards should be updated. Many of the policy questions raised in your hearings to date involve areas in which the SEC has primary policymaking responsibility, such as market structure, payment for order flow, short sale regulation and disclosure, the settlement cycle, enhanced broker-dealer financial responsibility requirements, and whether certain communications with retail investors constitute recommendations that should be covered by the SEC's regulation best interest. We will support the SEC in its review of these areas and then align FINRA's rules and oversight activities where necessary or appropriate. My written testimony offers some further perspectives on key topics under the SEC's jurisdiction and also describes some areas where we are considering whether updates or guidance regarding our own rules would be appropriate. For example, we intend to review by broker-dealers, as well as continue our review of the effects of gamification on retail investors. FINRA looks forward to working with this committee, the SEC, and our fellow regulators to review and learn from these recent market events so that we can strengthen investor protections and enhance confidence in our nation's capital markets. Thank you, and
Thank you very much, Mr. Cook. I now recognize myself for 5 minutes for questions. And this question is for Chair Gensler. This committee has examined numerous issues that have arisen out of the GameStop short squeeze that took place early. Systemic risk arising from firms such as Citadel, who are executing close to 50% of all U.S. listed retail volume. During the first hearing, I questioned whether Citadel poses a systemic risk to our financial markets. I'm also concerned about what Citadel's outsized market impact means for pricing and best execution, another market structure issue that this committee has examined as part of these hearings. As the newly confirmed chair of the SEC, what will your approach be with respect to mitigating the risk associated with outsized market impact and understanding threats to our financial stability?
Thank you for that question. I thank you for that question. I think that at the heart of well-functioning markets and the mission of the SEC, fair, orderly, and efficient markets, is promoting competition in markets. It can be done through transparency, but it's also by looking at our rule set to make sure that our rule set inspires more competition rather than concentration. And we have seen, as you noted in your hearing, an increasing concentration in market making and also separately in brokerage, and particularly around retail order flow. And so I've asked the staff, both from the Division of Economic Research and Analysis and Trading and Markets, to sort of give us a view, give internally the commission a view. What should we be thinking about in our market structure to address this? We've seen such comments. We know it's in search. When we all go online and search, there's really one dominant search engine. We know it's true in retail, buying retail products online. There's some dominance to that. And so our economy does tend towards certain, what's called in economics, network effects. So I've asked the staff to help provide us with guidance as commissioners. How do we promote competition in the face of these network economic effects that are?
Well, I want to thank you for that response. And I think what I'm hearing from you is that there is real concern about concentration. And while you have instructed staff to do some additional research to determine the extent of it, it is something that we should be concerned about. Is that correct?
Yeah, yes, I think that capital formation for issuers and for investors on the other side benefit from some broad competition amongst market actors. And as we get more concentration in the middle of the market, whether it's market making or brokerage, we could lose that fragile markets, meaning less orderly, and also more costly or less efficient markets. And that's what history and economics tell us when we get concentration.
Well, thank you very much. I appreciate the concern that you are identifying as you talk about this concentration and what could happen if, in fact, we're not aware and make some efforts to deal with it. With that, I'm going to basically call on Mr. McHenry for his questions.
Well, thank you, Madam Chair. And Chairman Gensler, thank you for being here, and welcome back before the committee, and congratulations on your new role. I know that Acting Chair Lee, at the time of the GameStop, this GameStop trade, emphasized that the core market infrastructure is quite resilient. Does the commission intend to release any additional findings?
Thank you. And thank you for our meeting earlier this week. I look forward to doing those on some regular basis with the chair and you and the subcommittee and other members. We are looking at putting together a report. I'm only in my third week in the job, but our economists, our trading and markets folks have come together, and I think we'll be releasing a report sometime this summer that will more detail the range of activities out of the January events.
Well, thank you for that. Small businesses right now are emerging from the pandemic, just like everyone is, and these small businesses need access to capital. And as you know, I've been focused on some of the burdensome requirements of the original regulation crowdfunding, which I helped legislate. President Obama signed into law. There have been some helpful changes made to Reg CF to make it more efficient, and trading in Reg A and Reg CF securities such as preemption under certain state regulations. Do you support these streamlining efforts for small businesses, and are you looking at additional?
I look forward to working with you and your staff to learn more about your initiatives and suggestions, but at the core, and maybe it's just a bit because my dad had a small business, never more than 30 employees, and didn't access the broad capital markets, but I think that small business entrepreneur efforts are really kind of, if I might say, a bit of the backbone of American entrepreneurism and our economies. And so access to the capital markets is a critical piece, whether it's accessing loans that might be securitized in the markets or accessing through equities. But I look forward to hearing more from you and your staff on ideas.
Okay, but no comment on Reg CF?
I again, just 3 weeks into the job, but I haven't looked closely at Reg CF yet, or frankly gotten a detailed enough briefing to see how we can, as you say, and I really do believe this, facilitate capital formation up and down the issuer spectrum.
Well, let's pivot to something that you spent some time out of government understanding. I think what we've all tried to seek is greater collaboration across agencies on the regulatory framework for digital assets, cryptocurrencies, notably. This includes more engagement from industry and appropriate regulators. In 2019, the Commission staff produced the framework for investment contract analysis of digital assets. Since then, the staff has sought feedback on a number of issues most recently on the evolving standards and the best practices for custody. This is progress, but I believe more concrete steps are necessary to further the crypto market. As you look at this issue, what steps can you outline to bring regulatory clarity so that we can have a vibrant digital asset marketplace with legitimate money?
This will be very relevant for XRP.
Well, I thank you for asking that, and I think that this market, which is close to $2 trillion crypto asset market, is one that could benefit from greater investor protection within the SEC's current authorities. Our authorities around securities and around products, asset managers, and products that might invest in these cryptocurrencies. I think that, as you mentioned, we put out a comment, I think it was in October or November, asking for feedback on custody. I would hope that we would move forward and provide greater clarity around custody. I do think that working with Congress, and I think it's only Congress that could really address it, it'd be good to consider, if you would ask my thoughts, to consider whether to bring greater investor protection to the crypto exchanges. And I think if that were to be the case, because right now the exchanges trading in these crypto assets do not have a regulatory framework, either at the SEC or our sister agency, the Commodity Futures Trading Commission, that could instill greater confidence. Right now, there's not a market regulator around these crypto exchanges, protection against fraud or manipulation or a conflict.
Well, I've time for one final question, Chairman Gensler. I'm encouraged by your comments on crypto. Last year, the commission proposed to allow certain gig workers to have access to equity compensation under the SEC's rules. Will you commit to finishing this important rulemaking?
I again, in my third week, I need to get a briefing, commit to work with the staff, understand what comments came in, and trying to understand the economics around that rule set.
Well, thank you, and I wish you great luck in your tenure, and thank you for your testimony. Thank you for your outreach.
Thank you.
Now recognize the gentlewoman from New York, Ms. Maloney, for 5 minutes. We will go on to the gentlewoman from New York, Ms. Velasquez. The gentleman from California, Mr. Sherman, who is the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
These people are watching this streaming.
Responding to the ranking member,
pardon me. I'm not saying something.
Who wants to instill confidence in those buying and selling cryptocurrencies. The only confidence I have is that the U.S. currency, but cryptocurrencies, if they succeed, 1/7 the cash to control $100 million worth of this block of shares or that block of shares. So this raises the question: is 7-to-1 margin fine for everybody, and is that good for the markets? Margin be the rule for everybody, and we should plug the loopholes? Or should we continue to have a system where if you're a family office, you can have 7 times margin by calling it a total return swap, and if you're the regular Robinhood investor, you can only get 1 time margin? What do we do with what should the margin rule be?
Some very important questions that came out of the market events late in March, not the January ones, but the March events around a family office, Archegos. And they're currently, our family offices are outside of much of the SEC's remit, not all of it.
If I can clarify, this is not a question about family offices.
Okay.
Just have one investment company that has $1 billion and decides they want 7-to-1 margin. The fact this was a family office, put that aside. Whether you disclose it or you don't, whether you're a family office or a hedge fund or a billionaire, should you be able to get 7-to-1 margin? And if so, how come the Robinhood guy can't?
So I think that I've asked staff to better understand, and again, it's just the third week, the rules that were adopted by the SEC that are yet to go into final implementation around the margin for these securities-based swaps, how they would have affected the circumstance. But you're right, sir, that they are different than the retail investor. And this is true across our markets. And I've asked staff to better inform me as to what we should do there.
For Mr. Cook. When it comes to disclosing short selling, there's arguments on both sides as to whether to disclose what an individual investor is doing. Some say it's harmful, some say it's helpful, but there seems to be agreement that the aggregate information is helpful. We ought to know in aggregate how many people are how many shares of GameStop are short. You generate that information, but you don't put it on your website. I'm told that you provide it to the exchanges and they publish it if they want to, and often behind a paywall. Why doesn't FINRA disclose all this information to everybody for free as quickly as you can?
Thank you, Mr. Sherman. That's a great question. I think we are, as we look at disclosure around short selling, I think there are some good arguments that we can do more here. I've asked our staff to prepare a regulatory notice to solicit comment on changes to FINRA's disclosure here to make it more frequent and more granular. And certainly as part of that, we can look at the way in which that disclosure is disseminated.
Is there any justification for what is a regulatory agency generating this information and giving it to private companies for them to sell rather than?
I'm inclined to, I appreciate the gist of your question, sir, and I'm inclined to be biased towards making it publicly available. I don't understand all the history behind how this developed. I think that's something we need to look into, but I commit to that we can certainly do that.
Yeah, my time has expired, but I look forward to looking at not only payment for order flow, but how we get the best price improvements for
for raising taxes. In some markets like Hong Kong, they've been affected, but they have a very different income tax and capital gains structure, no capital gains tax. In other markets, they've shown to limit trading or subdue so they don't have the effect that is expected. I've not seen anything discussing FTTs and volatility per se. I would not.
Robinhood and other brokerages earlier this year.
I'm not aware of the reasons for other firms, so I'm not going to speculate about that. Robinhood did say that their decision was based on their ability to meet our margin charges. If we do T2 to T1, time is risk. I think that's been well explained that by lowering the period, the amount of open transactions that we have to charge margin against would get smaller. And our estimation is the volatility charge, which is a main component, will go down by 40%. So in that sense, the capital charge against Robinhood would have been smaller. But again, it's a little bit of apples and oranges because to say it would automatically happen without knowing the market circumstances, obviously, it's hard to say. But there would be benefit to firms in having lower capital charges.
Some have proposed going even further than T+1 and moving to real-time trade settlement, what sort of impact do you think this would have on the market liquidity?
We are now proponents for real-time gross settlement, as you articulate. You would lose all the benefits that a clearinghouse provides, all the netting efficiencies I spoke about in terms of, trillions of trades being netted down to millions of movements, or 100 millions of trades going down to millions of movements, and trillions of dollars being netted down. You would lose all that benefit. All transactions would either have to be pre-funded, and the securities would have to be on hand. So it would have a very large impact on institutional trading. It would cause liquidity issues across the marketplace. So a bridge too far in my eyes.
Thank you, Mr. Botson. My time's expired, and Madam Chairwoman, I yield.
Thank you. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Waters, for this interesting and much needed hearing. The question before us today is this: how can we, on the financial sides, as they pertain to inexperienced investors, and also how do we treat that investment advice that we're getting from unqualified
This guy is seriously trying to make the focal point us and not the failure to deliver stuff or anything to do with the actual company involved in enforcing reliant regulation over.
When that
going, and how does that fit within the current regulatory regime? When we talk about statements by people on social media and other places, just to be clear, FINRA doesn't regulate that environment, and we would look to the SEC in sort of understanding whether existing authorities around concepts like manipulation or providing investment advice might apply. I do think that what we are also seeing, though, at your point about retail investors making decisions without an intermediary or a financial advisor is an important one. As we see more of that happen, we are seeing a lot of that happen. I think we need to ask whether the existing regime is adequate in that regard.
Let me quickly get to Chair Gensler. I've worked with him when he was chair of the CFTC. Chair, how do we hold somebody accountable? Answer this for me. As Mr. Cook just said, the SEC, he said, is the one responsible. We hold somebody. What do we do about this, Chair Gensler?
I think you raise a good point. I know, probably like me, it's not about somebody's free speech rights on social media, but if somebody is trying to manipulate a market, to defraud the market through social media, and in our rapidly changing technology, it could be computers and not even humans, by the way. It could be computers communicating in. So the SEC is a cop on the beat. We're going to vigorously lean in against individuals and companies to try to assess, but we'll have to update our resources too to be able to see that relationships.
My time is coming down. How are you going to solve this? Do you feel that we can, so we don't have any more of this GameStop?
I don't know if the beeping, what Madam Chair I'm supposed to do, because the beeping is going.
Thank you. I would expect that you would respond in writing to that question as we move on. And I'm now going to call on the gentleman from Oklahoma, Mr. Lucas, who is now recognized for 5 minutes.
Thank you, Madam Chairman. And first, congratulations, Chairman Gensler, on your confirmation. I have confidence that you'll bring the same gusto and tenacity to your role as you did as chairman of the CFTC. And I look forward to working with you. And for the benefit of our colleagues, perhaps who are not on the Ag Committee, of course, Chairman Scott, you and I spent a lot of time in a previous position, both of us, working on a variety of issues over there. So that said, this company filings, and we'll begin to update climate disclosure guidance. As you can imagine, the industries that are vital to Oklahoma, thinking ag and energy, are very following this topic very closely. I'll put it that way. Chairman Gensler, could you shed light on what this enhanced focus mean? Does this represent a change from current SEC practices, or is this a continuation of current policy?
First, let me say thank you, and Chair Scott. I think we did some good work together on behalf of the American public, on behalf of agricultural interests across the country as well. If I can broaden it out a little.
And how the data is interpreted, that can have a dramatic effect. So with that in mind, give me a feel for what kind of a timeline we're looking at when we get to the review part of this process, where my folks can offer their insights.
Well, I hope if they wish, we could get some insight from them and input. Even there's an open comment period right now. The task force is looking at the guidance that's already in place. So there's guidance that was put out in climate, I think in 2010. And I think that it's two things. One is to see if companies are following that 2010 guidance and following the overall important disclosure regimes that are in place at this point in time. Two is it helps us and informs the commission, all five of us, as we move forward to consider rules, because we can sort of learn from what's happening right now. The Division of Enforcement, Division of Examination, what's going on now. So one is just are folks complying with the rules and laws that are in place, but two, it helps inform us about some of what's going on and how we can help bring more consistency and comparability in the future.
Thank you very
Thank
much.
you, Mr. Chairman.
The gentleman from Texas, Mr. Green, who is also the chair of the subcommittee on oversight and investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. And I thank the witnesses for appearing as well. And Madam Chair, as you know from the genesis